You ever get that weird feeling like the market is fine right up until it's not? Like nothing looks broken. Your 401k is humming along. The headlines are boring. People are casually talking about vacations again, and then, out of nowhere, something shifts. A big fund trims risk. Rates jump, stocks wobble, and regular people only realize what happened after their account balance changes. So here's a thought experiment. What if BlackRock, the biggest asset manager on the planet, pulled $2.1 trillion out of US markets? Not moved some money around. Not a small rebalance. 2.1 trillion. Now, to be clear, this is a scenario analysis, not a prediction. I'm not saying it's happening tomorrow, but if you understand what would happen in a scenario like this, you'll understand how markets really work and how to protect your money when big players reposition. I'm Alex. I spend way too much time thinking about money, market psychology, and why smart people still make emotional decisions when things get shaky. Let's break this down in plain English. No panic, no doom, just clarity. First, what does pulled money even mean? BlackRock doesn't pack boxes and leave the country. They manage portfolios. So pulling money would mean reallocating, reducing exposure to some US assets, and increasing exposure elsewhere. That could look like Odney selling some US stocks, reducing US Treasury bond holdings, shifting into short-term cash-like assets, moving into international stocks or bonds, adding gold or other hedges, using currency hedges to reduce dollar risk. It's not chaos, it's positioning, but when the numbers get huge, positioning becomes pressure. So what happens next? 1. US stocks, liquidity gets thin. If trillions start leaning away from US equities, you usually see the first hit in liquidity. Liquidity is just a fancy way of saying, how easy is it to buy and sell without moving the price? When big buyers step back, prices can drop faster, even if the underlying companies didn't suddenly get worse. Fewer buyers, more selling, wider swings, and the market doesn't fall evenly. The biggest index names can get hit hard because they're where the most money is concentrated. Yet even if you're not picking individual stocks, your index funds feel it. That's when regular investors start saying, wait, why is my retirement account down? 2. Bonds. Rates can jump. Now let's talk about the part most people ignore. Bonds. If a major player reduces demand for US treasuries, yields tend to rise. And when yields rise, borrowing gets more expensive. That filters into real life fast. Mortgage rates, car loans, business loans, credit card APRs. So even people who don't invest still feel it. Because higher rates change the whole economy. Housing cools, spending slows, hiring slows. This is one of the sneakiest ways big money moves become everyday pain. 3. The dollar, more volatility. If capital rotates out of dollar-based assets into other regions, the dollar can weaken, or at least get choppier. And a weaker dollar can mean imported goods cost more. That doesn't always show up overnight, but it can add pressure. And when families are already stretched, even small price increases feel loud. 4. The real people impact. 401s, KS, Y's, and Mood. Here's the part most videos skip. If markets drop and rates rise, retirement accounts can take a hit. Not game over, but a hit. And that's where the real danger begins. Not the drop itself, your reaction to the drop. Because the average investor doesn't lose money because the market moves. They lose money because they panic at the wrong moment. They sell after the fall. They wait for things to feel safe. They buy back after the rebound. And that cycle quietly destroys long-term returns. Also, higher rates can squeeze businesses. Less cheap money means less expansion. That can mean slower hiring and, in some sectors, layoffs. So yeah, big capital rotation can change the vibe. The mood of the economy matters more than people admit. Now, why would a giant like BlackRock reposition in the first place? Usually it's not one dramatic reason. It's a stack of reasons. Interest rate expectations changing, US debt and deficits becoming a bigger headline, geopolitical risk rising, valuations feeling stretched, better opportunities elsewhere, clients demanding lower risk. Remember, institutions are risk managers. They don't feel the market the way individuals do. They don't fall in love with the stock. They don't panic scroll social media at 2 a.m. They adjust exposure. So the smarter question isn't, is the US doomed? The smarter question is, what kind of world are they preparing for? And then we pivot to the part that actually helps you. How do you protect your wealth when big money moves? Here are the rules I'd follow. Simple, practical, no hero moves. Rule number 1. Don't confuse headlines with signals. Headlines are designed to spike your heart rate. Signals are designed to improve your decisions. If you see scary news, don't do anything in the first hour. Seriously, make a rule. No trades on adrenaline. Rule number 2, check your concentration. Most people think they're so diversified because they own an index fund. But indexes can be concentrated too. Ask, am I overloaded in one country, one sector, one style of stock, one hot theme? If the answer is yes, the fix is not panic. The fix is rebalancing, slowly, intentionally. Rule number 3, build a cash buffer for options. Cash isn't wasted if it buys you flexibility. A real buffer means you don't sell investments just to cover a surprise bill. You don't swipe a credit card because your emergency fund is thin. You can ride out volatility without stress selling. I'm not saying hold a mountain of cash forever. I'm saying enough cash to keep you from making desperate decisions. Rule number 4, match your risk to your timeline. If you need the money soon, don't put it where it can drop 30% next month. Short timeline, safer assets. Long timeline, you can take volatility. Most people don't lose because they picked bad investments. They lose because they took the right risk at the wrong time. Rule number 5, automate the boring. So you don't do the stupid automation as your best defense against your own emotions. If your paycheck hits and investing happens automatically, you win. Because you remove debate. You remove, I'll do it later. You remove, I deserve to spend this. Automatic investing turns discipline into a system. Now let me give you a simple timeline because this helps people stop guessing. Phase 1. The whisper big funds start trimming quietly. Nothing breaks, but the market feels jumpy. You see random down days for no obvious reason. Phase 2. The headline, a big number hits the news. Everyone suddenly has an opinion. This is when emotions spike and bad decisions happen fast. Phase 3. The reset prices adjust. Rates settle. Capital finds a new home. And the people who stayed calm usually end up with the best entry points. So what can you do this week? Like literally this week, so you're not guessing later. A. Write your simple plan on one note. How much do I invest each month? What do I do if the market drops 10%? What do I do if it drops 20%? If you can't answer those, you don't have a plan. You have hope. B. Turn on one automation. Auto transfer to your investing account. Auto buy a broad index fund. Auto build your emergency fund. One automation is better than 10 intentions. Reduce one silent expansion, cancel one subscription, lower one default expense. Not to be miserable, just to stop lifestyle creep from eating your future. Because the truth is why most people don't lose money in a crash. They lose it slowly, in normal times, by letting spending expand and discipline shrink. And that's why this topic matters. Even if BlackRock never moves $2.1 trillion tomorrow. Because big money always shifts. And the real skill is being ready when it does. If BlackRock pulled $2.1 trillion from US markets, here's what I'd expect. More volatility, tighter liquidity rate pressure, a stronger emotional environment for investors. But here's what I wouldn't expect. The market disappearing. America ending. Or wealth being reserved for insiders only. Markets adapt, capital rotates. And the best opportunities often show up when people are most emotional. So the real takeaway isn't be scared. The real takeaway is be structured. Because wealth isn't built by dramatic moves. It's built by resisting silent expansions. It's built by staying calm while others chase headlines. It's built by being prepared before the storm, not during it. So ask yourself, honestly, if the market got shaky next month, would you panic or would you be positioned? Because that answer tells you everything. I'm Money Mentor Alex. And remember, big money repositions, smart investors prepare.